My guest today is financial expert and best-selling author James Rickards. Jim has over 35 years of experience working in capital markets on Wall Street. In 1981, Jim was involved in negotiating an end to the Iran hostage crisis. Jim was also a chief negotiator in the 1998 bailout of long-term capital management, and he's been called upon by the U.S. government to contribute intelligence on financial terrorism, insider trading, and currency manipulation. His long list of clients include institutional investors as well as government agencies. He has been interviewed in the Wall Street Journal and has appeared on CNBC, Bloomberg, Fox, CNN, BBC, and NPR. He is also an op-ed contributor to the Financial Times, New York Times, and Washington Post. Jim?
Yes.
Good to have you today. I've been reading your book, The Death of Money. I'm telling you, what a great book.
Well, thank you very much. It's nice to hear.
It is just fascinating. I'm telling you, it's really great stuff. I wanted to start off the program today with a question for you. Can you tell our listeners a little bit about how you came to work in government intelligence and explain a little bit about your work on the Project Prophecy and what was the end result of that?
Yeah, that was a project conducted, a strategic study conducted by the CIA over multiple years to look into what really started as insider trading before 9/11, but the CIA wasn't really involved in getting to the bottom of that. That was really the job of the 9/11 Commission and the SEC and the FBI and others. What the CIA was interested in is, okay, let's assume that there was insider trading. If there were going to be another attack of a spectacular kind, would there be insider trading again? Could you spot it? And if you could spot it, could you trace it back to the source and using proper legal process, get a warrant and, break down the door and stop the attack and save thousands of lives? That was the question. They didn't know the answer. They wanted to study it, but of course, the CIA did not have a lot of capital markets expertise, and why should they? The capital markets were not really part of the battle space during the Cold War, even throughout the 1990s. So, as they frequently do, they engaged in outreach. They called various market experts. So I was literally tapped by someone who was involved, and based on my background, not only in finance in general, but I had worked in the Middle East. I'd worked in Pakistan. I was an expert on Islamic banking. I'd done a lot of things early in my career that would maybe give me a little bit more insight or a little bit of an edge into the mind of the terrorists, because obviously the terrorism was coming from Pakistan and Afghanistan and Islamic fundamentalists. So I was asked to volunteer, and of course I immediately said yes. And actually over the years, I ended up recruiting more people myself. And one of the things that was very heartening is we were never turned down. Whenever we asked people if they would volunteer their time and effort, they always said yes. They would do whatever they could to help the country. And so I came on board as a volunteer, but I started writing and getting more involved. And as I got more involved, I actually became a co-project manager under the direction of Randy Taus, I mentioned in the book. So that was the beginning of it.
Was your conclusion then from that study that 9/11 was actually an act of financial terror?
No, 9/11 was an act of physical terror. They crashed planes into the World Trade Center. But certainly Osama bin Laden was very conscious of the financial impact. He was using, let's call it conventional terror, using planes as flying missiles in effect. Osama bin Laden was very cognizant of the potential financial impact. In fact, I quote in the book from an interview he gave where he calculated in his head the financial damage caused by the 9/11 attack. So there's no question that Al-Qaeda all along has been thinking about financial damage to the United States as one of the ways that they could attain victory. So it was physical terror, it was violent terror, murderous terror, but you're correct that they did in their minds have the financial impact very much front and center.
Well, weren't they going in and shorting stocks prior to the 9/11 attacks? Wasn't that an analogy that you drew in your book?
Well, it wasn't an analogy. I actually drew that conclusion and gives statistical, academic, forensic, and anecdotal evidence to support it. So it's very clear that there was insider trading ahead of 9/11.
Very factual book. I'm telling you, it's really incredible. I'd highly recommend it to people out there. That it's just a fantastic read. Really fascinating. In your book, you also explain the dangers of exponential function of scale. It sounds kind of complicated, but, can you explain?
Well, it really isn't. I mean, the scale is just a word that physicists use for size. So I talked about the scale of the system. That's the technical term, but just think of it as the size of the system. And you say to someone, well, What would happen if you triple the size of the system? What would the impact on risk be? Well, if you ask Jamie Dimon and the people at, J.P. Morgan, they would say that there's very little additional risk. And the reason they say that is because they're looking at it as long, short, long, short, long, short. In other words, all these positions balance off against each other, and you kind of ignore the gross and look at the net and use these value at risk models, and it would tell you that there's only the net exposure, it's quite small, it's manageable, you have enough capital, et cetera, et cetera. That's complete garbage because the value at risk models are garbage. The risk is not in the net, it's in the gross. So now go over to everyday person on the street who's not necessarily a dynamic systems analyst or a financial economist and say, what do you think would happen if you triple the size of the system? They would probably say, well, you'll triple the risk. In other words, it's a linear function. It's sort of an intuition. If you make something 3 times bigger, you increase the risk by a factor of 3. Well, Jamie Dimon's wrong, and the everyday intuition is wrong. The correct answer is that when you triple the system, you increase exponentially, meaning 10 times or 50 times or 100 times. You don't even know how many times you're doing it because all the empirics behind this theory have not been totally worked out yet, but you can bet that it's a multiple of whatever it is you're doing. Now, the same phenomena exists in natural systems. The complexity theory and the self-organized criticality and the dynamic systems analysis I talk about don't just exist in financial markets. In fact, they've barely been researched in financial markets. I'm one of the ones doing that. But they do exist in many other phenomena, whether it's solar flares, earthquakes, power grid outages, internet backbone failures, etc. It exists in a lot of other places. And when you look at those other places and say, okay, what's the worst thing that could happen? Let's take earthquakes, for example. Take the San Andreas Fault in California. Well, what kind of earthquakes does it produce? Well, sometimes it's like a 3.0 on the Richter scale. That's something you can feel but doesn't really do a lot of damage. Sometimes it's a 5.0 on the Richter scale. Now you not only can feel it, but it does some damage. Maybe some walls come down or some windows break and so forth, all the way up to, let's say, an 8.0, which is catastrophic and would kill thousands of people and cause billions of dollars worth of damage. Well, that's normal behavior in a complex dynamic system where you're going to have a whole bunch of 3s and some fewer 5s, and very rarely will you have an 8, but you'll have one every now and then. But nobody thinks it's a good idea to go out and make the San Andreas Fault bigger. Nobody thinks we should send in the Army Corps of Engineers to make it bigger so we can have bigger earthquakes. But that is what we're doing in financial services. We're making the system bigger by adding on derivatives, by adding on off-balance sheet items, by increasing leverage. We're making the system much, much bigger. So in effect, we should expect bigger earthquakes, bigger than we've ever seen before. We should expect financial catastrophes that are exponentially larger than anything we've seen in the past. And that's what I write about in the book.
So the larger the system, the greater the risk?
Well, I would say the larger the system, the exponentially greater the risk.
If we go back to 1980, the national debt as well as GDP was right around $1 trillion, wasn't it?
I'm not sure just what it was in 1980, but we need to go back and look. It's easy enough to look up, but it's certainly much, much greater today. But it's not just that. I mean, the debt is kind of visible. The GDP is visible. Those are much bigger numbers. You're right about that.
The derivative bubble today is the problem, isn't it, Jim?
That's exactly right. Derivatives are approaching 10 times global GDP. Global GDP is about, round numbers, about $70 trillion, and we have about $700 trillion of gross notional value derivatives. So it's 10 times global GDP and growing faster all the time. So that's what I mean by making the San Andreas Fault larger. You're not just going to increase the risk, you're going to increase it exponentially. And since the system's never been bigger, it follows, as a matter of science, that the catastrophe will be exponentially bigger than anything we've ever seen before, and it will be bigger than the Federal Reserve.
Right. There is so much money floating around the world, and banks around the world are very interlinked, aren't they?
Yes, and this is what the IMF calls, they refer to it as spillover effects or contagion effects. I'll give you a very specific example. I was in Tokyo in September 2007, right around the time the U.S. mortgage market started to melt down. Now, the panic stage came in 2008 with Lehman Brothers and AIG, but the mortgage crisis, the subprime crisis, actually became very visible in 2007. So there I was in Tokyo, and the Japanese stock market was going down very rapidly, and the Japanese, said to me, wait a second, we understand that you Americans have a mortgage problem, but why is our stock market going down? What does one have to do with the other? And I explained to them that when you're in financial distress, you don't sell what you want, you sell what you can. In other words, U.S. hedge funds and money managers were selling Japanese stocks to get cash to meet margin calls on the mortgages because they couldn't sell the mortgages, or at least not at prices they wanted. So they would have loved to dump the mortgages and keep the stocks, but they couldn't get a good price on the mortgages, so they sold the liquid stocks to get cash to meet the margin calls. So that's a very good example of how the mortgage crisis very quickly spilled over into the Japanese stock market, even though superficially one should have nothing to do with the other. Well, just take that example, multiply it by 1,000, and apply an exponent to it, and you can begin to get some idea of the interconnectedness and complexity of the system as a whole. And when we have a crisis in one area, don't think that it can be contained. It'll pop up in some other market. I mean, Dubai is a perfect example. Dubai World defaulted on their debt in November 2009. It was really the day after Thanksgiving, and that turned into a European sovereign debt crisis. Well, what did Dubai have to do with Europe? Well, the answer is no sooner, once Dubai defaulted, everyone took a look at Greece and said, wait a second, you guys are a mess, and then Greece got in the distress, and then that spread to the periphery, to Spain, and ultimately Italy, and almost took down the euro. So these are all examples of how the system is densely connected, densely networked. The spillover effects happen very rapidly. They're greater than ever, and we should expect to see that again.
So has the size of the derivative market actually been reduced since the Great Recession, or has the problem gotten worse? What's your opinion on that?
Well, it's not an opinion. It's a fact that it's not being reduced. It's getting bigger, and we don't have to guess. We actually get numbers from the Bank for International Settlements in Basel, Switzerland. They publish an annual report, and they have a survey of the gross notional value of off-balance sheet derivatives of all the major banks. So we can actually look at the data, and the answer is it's getting bigger. That you go back to 2008, what did we hear about? Everything was too big to fail, too big to fail. Well, guess what? Since 2008, the 5 largest banks in the United States are bigger than they were at the time. They have a larger percentage of the total banking assets in our system, and the derivatives books are much bigger. So by those measures, the system is not safer. It's much, much riskier. Yeah, they've added capital, but not nearly enough to cover the risk. And so when the crisis comes again, which it will, because they happen every 5 or 6 or 7 years, they'll wipe out the capital and they'll be back over to the taxpayers, except this time, that is to say the next time, it'll be bigger than the Fed. The Fed papered it over the last time. The next one will be sufficiently larger that the Fed will not be able to do that.
Well, do you think people are putting too much faith in the Fed these days?
I wouldn't put any faith at all in the Fed. Yeah, the answer is definitely putting too much faith. If you have any faith in the Fed, that's too much, for a couple of reasons. Number one, the Fed was not created to help the economy. The Fed was created to help the banks, and that is still their mission. Anything the Fed does for the economy is by accident. What they really do is they try to prop up the banking system. That's why they have a zero interest rate policy. They pay savers nothing, so the banks can get free money and lend it out on a leveraged basis and get very good returns on equity to rebuild their capital bases. So that's what's going on there. The Fed demonstrably does not know what they're doing. I mean, look at the fact that they've had 15 separate policies since 2009. You know, they offered forward guidance. They said we won't raise rates until 2013. Then they said 2014. Then they said 2015. They had QE1, QE2, QE3 Part 1, QE3 Part 2, forward guidance, currency wars, Operation Twist, zero interest rate policy, nominal GDP targeting. They came up with a 6.5% unemployment goal. They got there and then threw it away, said that doesn't mean anything anymore. So if you have 15 policies in 5 years, it says you don't know what you're doing. And I've spoken
a little schizophrenic.
Well, they're guessing. It's an experiment. We're all guinea pigs in a central bank experiment, so I wouldn't have any confidence in them at all. In fact, not only would I say they probably don't know what they were doing, I would say they definitely don't know what they were doing, and I've been told that by central bankers. Members of the Federal Open Market Committee, members of the Monetary Policy Committee of the Bank of England have said to me privately, we were making it up. We'd try something. If it worked, great. If it didn't work, we'd try something else. They don't know what they're doing, so you shouldn't have any faith in them at all.
Since the stock market bottomed on March 9th of 2009, of course, it's floated higher, and a lot of credit's been given to QE 1, 2, and 3. What's your opinion? Why is the stock market, floating higher? Is it because we're seeing real growth here in the United States, or is there something different going on?
No, it's not coming from real growth. Real growth is sort of anemic. It's coming from leverage and free money. there's nothing Wall Street doesn't like about free money. So if you give them free money and let them use leverage, they'll bid up the price of assets. It's exactly what the Fed wants, by the way. Of course, it's just creating another bubble. The dot-com bubble burst in 2000. The housing bubble burst in 2007. Now we have a double bubble, housing and stocks, and they're going to burst, soon enough. Maybe, I'm not saying tomorrow or next month, maybe not till next year, but when you create these new bubbles, they will burst and they will produce very catastrophic outcomes. So it doesn't really come as a surprise to me. If you said, hey, Jim, I'm going to give the market unlimited free money and lots of leverage, I would say, okay, asset prices are going up.
So do you think if the Fed was to continue with QE and maybe even increase its asset purchases, do you think they could continue to just float the stock market up indefinitely?
For a while, but not indefinitely, because eventually, all of a sudden the money illusion goes away, the mirage goes away, people get nervous, the Fed's balance sheet looks, by the way, the Fed's already broke on a mark-to-market basis. The Fed is insolvent on a mark-to-market basis. They're leveraged 80 to 1. If you took their assets and marked them at today's prices, it would wipe out their capital. So a dollar could be understood as a perpetual non-interest-bearing liability of an insolvent central bank. In other words, the Fed's already broke, but that's not apparent. It's going to be an issue in the political campaign in 2016, by the way. Some of the presidential candidates are already talking about this, so you're going to be hearing a lot more about that in the years to come. And that's going to call attention to it. And the Fed's going to have to do one of two things. They're either going to have to stop, keep the taper going, stop the asset purchases, start to unwind a little bit and get their balance sheet back into better condition. Of course, that'll throw the economy into a second recession within the Depression. Or they can keep printing money, which will keep the game going on a while longer, but eventually the bubbles will burst and we'll have a catastrophe of a different kind. So it's going to end badly. We just don't quite know how.
Do you think that will affect the value of the dollar?
Sure, because it's only based on confidence. And confidence is fragile. It's easily lost, and once you lose it, you can't regain it, at least not very easily. So they're abusing the trust. They're abusing the confidence. For the time being, it is working. We haven't had that disastrous outcome since 2008, but eventually the magic will wear off, if you will. People will see what's going on, and they'll walk away from the dollar, which Warren Buffett is already doing. Warren Buffett's out buying railroads, oil, and gas. Those are all hard assets. Warren Buffett's dumping paper money, buying hard assets as fast as he can.
Seems as though Warren may be a little concerned about the future as well. It was reported that gold demand in China is slowing down. In your book, The Death of Money, you say that China's biggest threat is inflation taking off in the United States before they get a chance to rebalance their gold. Can you elaborate on that a little bit?
Well, China has about $4 trillion of reserves, the vast majority of which are denominated in U.S. dollars, and most of that is in the form of U.S. Treasury securities. So, there's an old joke in banking that if I owe you $1 million, I have a problem, but if I owe you $1 billion, you have a problem because you've got to collect it from me. Well, China, everyone thinks that they have the U.S. over a barrel because we owe them $4 trillion, but it's actually the opposite. We could just say, hey, China, here's your $4 trillion. We just printed it. Good luck buying a loaf of bread. In other words, we'll inflate the debt away. So China's very vulnerable to that, so they're acquiring gold to, in effect, create a hedge position. They can't dump their dollar assets. They can't do that. The market's big, but it's not that big, and they would cause a meltdown and a catastrophe and a depression, in the United States, which would hurt their export goods before they could ever get rid of a small fraction of what they have. So they're stuck with what they have. But what they are doing is building up a gold component of the reserve position. That way, if the dollar is stable, which is what they want, they're the biggest dollar fans because they're the biggest dollar creditors. If the dollar is stable, they might not make very much on their gold, but they'll get paid back, 100 cents on the dollar on their bonds. If we inflate the dollar and in effect steal from them on the bond side, they'll take a loss there, but they'll make it up on the gold because any kind of inflation like that is going to make gold go way up. And so what they're really doing, there's been some speculation that they want to launch a Chinese-backed reserve currency backed by gold. That's not true. They're nowhere close to being able to have a reserve currency. But what they are doing is creating a hedge position, have a lot of gold, maybe 4,000 tons, aiming higher to offset the paper vulnerability they have to the U.S. dollar. As far as purchases slowing down, maybe the reported purchases are slowing down, but I just got back from Hong Kong and I talked to one of the leading secure logistics professionals, people who run armored car companies and gold transportation companies. He told me the opposite. He said that he sees no let-up in demand. And I also mentioned in my book that China is doing things off the books, using People's Liberation Army assets, including armored personnel carriers, to bring gold in through Central Asia. So I don't really trust the public figures.
So they actually have more gold than what's being reported, right?
They have a lot more gold than they're reporting. We know that, but the question is how much. We don't necessarily have a good handle on, of all the gold that's imported. We don't know how much goes to private demand, how much goes to the government. Then all the gold that's reported is not all the gold they have, because they're bringing in some gold that's not reported. So you really can't take those figures at face value. They mean what they mean, but they don't give you the whole picture.
And you thought that would probably take place, the rebalancing, sometime in 2015. Is that correct?
That's an estimate. That's what I say in the book. I don't know that for sure, but I based that on the fact that, the last time they updated their reserves was 2009, and the time before that was 2003. So there was a 6-year gap in between. The Chinese actually don't like to do things differently. If they like to do things the way they've been done before, and so having waited 6 years the last time, my estimate would be that they would wait 6 years the next time, which means that the next disclosure would be in 2015. But, that's just my own estimate. I don't have any inside information. Maybe they'll do it sooner, maybe they won't do it at all, but that is what I...
And if that occurred, then, Jim, if that occurred in 2015, I'm living back in the 1900s. I just turned 60 in December. If that was to occur, what do you think it would do to gold and gold prices at that time?
I think it would.
Would that take the lid off of inflation here in the United States? Is that what I'm reading into this when I'm listening, in the book, that after this rebalancing takes place, that the lid for inflation will be at least somewhat off here in the United States?
Yes, because if you have that kind of inflation today, China doesn't have enough gold. They're going to lose on the paper, but they don't have enough gold. Europe does, and the U.S. does, and Russia does. Europe, the U.S., and Russia all have, their gold to GDP ratio is somewhere between 2.7 and 4.3%. China officially is 0.7%. Unofficially, they might be as high as 2%, 2.1%. They're not up to let's call it the 2.7% level. So if inflation took off today, Russia, the U.S., and Europe would be partly protected by their gold holdings, but China doesn't have enough gold. China would be left in the dust, and China's saying, in effect, hey, we're the world's second largest economy. You developed economies want us to be a good, citizen on the world stage. Well, don't, in effect, steal from us by inflation. And so China, the way to prevent that is for China to get enough gold so that it has gold on a par with the United States and Europe. Well, they're not there yet, but they're getting close. But once they are there, then you could say, well, the whole world can inflate, and China will not be left behind. So I view this China's acquisition of gold not just as a portfolio rebalancing by them as part of an effort so that they have the same inflation hedge that Europe and the United States have.
So there's kind of a cooperative effort going on between the nations.
That's right.
You seem to think that we might return to a gold standard at some point. What do you say to the people who say there's not enough gold in the world to return to a gold standard?
Well, there's always enough gold. It's just a question of price. In other words, if you price it at, today's price is around $1,300 an ounce. If you price all the official gold at $1,300 an ounce, that is not a big enough money supply to support world trade and world finance. It would be extremely depressionary and deflationary. So it doesn't mean you can't go on a gold standard. It just means you have to get the price right. So the question I ask myself is, what is the implied non-deflationary price of gold? In other words, what would the price of gold have to be to support the trade and finance that we already have going on? In other words, to support the existing money supplies. Well, I've done those calculations, and, there's some assumptions that have to go into it. You have to decide, which countries are going to be included. When you're talking about money, is it, M0, M1, M2, those are all different measures of money supply, and you have to ask yourself, what percentage backing am I talking about? Do I want 40% backing or 100% backing? So there are some parameters you have to put in, but once you've done that, the way I've explained in the book, my estimate is $9,000 an ounce. So at $9,000 an ounce, the existing gold supply does produce enough money supply to support trade and finance. At $1,300 an ounce, it doesn't. So that doesn't mean you can't have gold. It just means you've got to take the price to $9,000 to have a gold standard.
So it's just a matter of math, isn't it? Do you think hyperinflation is possible or maybe even probable here in the United States? Is that what you're seeing in the future?
Yeah, it's certainly possible and maybe probable. I think it's a good way to put it. I would define hyperinflation. My definition is anything more than 10% a year, and some people would disagree with that. They would say it's got to be much higher than that. But maybe, 10% a year, the value of your money is being cut in half in 6 years. I consider that hyperinflation. But, whether you accept that designation or not, if you're talking about 10% inflation, I can definitely see that coming. See, the way the Fed thinks about it, the Fed wants to get inflation to around 3.5. They want to get inflation higher than interest rates so you can have negative real rates, which is a powerful inducement to borrow, invest, to try to get the economy going. But they're not succeeding in that. Inflation is only about, between 1% and 2%. So they're going to print more money until they can get it up to where they want to go. But my point is, as inflation goes from, 2% to 2.5%, 3%, 3.5%, and at that point, the Fed will say, okay, now it's getting close to 4%. We have to dial it down a little bit. What they're going to discover is that expectations have changed, and it goes up to 7, 8, or 9. In other words, it's very, very hard to bend the curve, very, very hard to get people to change the mentality from deflation to inflation. But once you do, it's very hard to get them to change back again, because you're talking about human behavior, which really, from the Fed's perspective, has to be manipulated. You have to lie to people to get them to do what you want. And so I think it'll be very difficult for the Fed to get inflation to 3%, but if they do, next stop is 8 or 9%, because at that point, the expectations have changed and behavior has changed.
So at 10% inflation rate, do you have any projection as to what that would do to the gold price?
Well, look at what it's happened before. See, everything in the book I talk about has happened before. From 1977 to 1981, in a 5-year period, cumulative inflation in the United States was 50%. So that was about 10% a year over a 5-year period. And during that period, gold, actually go back to 1971, it was $35 an ounce. By 1980, it was $800 an ounce. So we know what inflation does to gold. It takes it sky high now. Who knows how much? If you think there's going to be a gold standard, you'd probably be at the $9,000 range. But even if it were just regular inflation, gold could easily go to $3,000 or more. So I think that's not a stretch. And A, I think it could happen. B, I think that is what would happen to gold.
Well, Jim, I really appreciate you being with us today. I'm telling you, that book, The Death of Money, everybody ought to get it. It's a great book. There's a lot coming. Don't be looking for snowflakes and avalanches is one of the things you state in your book, and it's a great statement, and appreciate you being here, and hopefully we can do this again.
I hope so. Thank you.
Thanks a lot, Jim. You can buy Jim's book, The Death of Money, online at Amazon.com. If you'd like more information about how to protect yourself from the coming collapse of the dollar, call ITM Trading at 1-888-OWN-GOLD. That's 1-888-OWN-GOLD.